Hi, hope you're doing well. Today we're going to start talking about what a business actually is and how it fits in the bigger picture within an economy. So we're going to have kind of like a very short crash course on economics so that we really understand what a business is and how it actually fits into the bigger context. So let's first discuss quickly what a business is. A business is an entity that tries to survive, meaning make a profit, by making and or selling products and services in the marketplace for the most part, right? So what does that mean? Well, I think at the essence of that is trading with somebody else, right? So you need to have consumers or other entities that will be maybe other firms that are interested in something of value that the firm is creating or distributing, okay? So we're going to make a distinction between goods and services. And so a good is something that usually you can perceive with your senses, right? You can touch. Okay. So typical examples will be food, right? Or maybe a car, right? Or a pair of sneakers, right? Those are all goods. Everybody knows what those are. No surprises. Now, what is a service? A service is essentially a performance. Okay, it's something of value that it's literally performed, right? So, what are we talking about? For example, when you go to the dentist, right? When you go to the dentist, what you're trying to do is you're trying to have a person that is more knowledgeable than you over a particular field help you maybe feel better, right? Let's say they have a toothache, right? So that service may actually entail some goods. So they might have some products that they use at the dentist, like God provide, right? A drill, right? Or maybe a syringe with some Novocaine on it so that you don't feel so bad when they're actually drilling your tooth. Hopefully you don't need to get that service performed, but anyway, a dentist, right? So it's different than a product, okay? And how is it different? Well, there are several ways in which it's different, but the most important ways you have here is intangible. That means that it's not easily perceived by some of your senses. Particularly intangible comes from touch, so it cannot be touched. And that creates a whole host of difficulties from a marketing perspective, right? We'll talk about some of this chapter 11 and 12 maybe when we're discussing marketing, right? How are you going to tell somebody how valuable your service is if they cannot actually perceive it easily, right? That's a challenge. Also, it's fully dependent on the interaction with the consumer, so it's inseparable. What do I mean by that? If you're going to get a haircut, that haircut cannot actually happen unless the person is physically there, right? So you cannot separate the customer and the performance of the service from the service itself. Unlike with a product where you can make it in a factory and then ship it wherever it needs to be bought. That creates a whole host of difficulties from a perspective of logistics, right? It's also perishable. So if you're an airline company and you don't get to sell some of the tickets, once that they plane the parts, there is no getting those seats back, right? So it's perishable. Okay, you cannot just store it for a later consumption, and that creates even more difficulties from a managerial perspective. And finally, it's highly variable. What do I mean by that? Well, if you've been in a restaurant before, and I assume you have, you know, even if it's the same restaurant, the service you're going to get varies by the day. Maybe the waiter or the waitress was having a bad day, right? We've all had those. And because of that, maybe they're just forgetful, or they are a little bit more rude, or they have too much work, and because of that, they can't actually keep up, right? So it's variable. Like the quality you're going to get, it's going to depend on the actual encounter. And services, because of this, they are more challenging, and they also offer more opportunities to do better as a business, I will argue. Now, I want you guys to realize that modern economies like the US are mostly service economies. Upwards of 80% of all value or wealth generated in this country comes from services. So we're mostly a services economy. And the book also makes a distinction between services and ideas. I will argue these two are very closely related, okay? So I don't want to make a big to-do about what is the difference between an idea and a service, because I will argue that most of these ideas are really services. You know, when you go to an accounting firm for advice, you're receiving a service, right? But idea is the knowledge that the accountant has that makes him or her time valuable. Same thing with a lawyer or any other professional. Hopefully, you know, after you finish college and you start working, your services be more valuable because you have more knowledge. So these ideas are inherently valuable. And this is kind of like a continuum from here to here. Okay, so you're trying to expand this part. Okay, most modern economies are operating mostly in this space. Most of the production facilities have been moved elsewhere, for example, to China. And now I guess we're suffering some of the consequences of that outsourcing. But anyway, I digress. So a business is essentially an entity that provides something of value, either a good, a service, or an idea, and it's doing so basically to survive as an entity, and to do that, they're trying to earn a profit. Okay? Now, let's go to the next one. Then what is a nonprofit, right? A nonprofit is an entity that is trying to maybe improve society, right, in some way. There are different nonprofits that have different ideas on how they can actually do that. It's a very noble but challenging task, right? We're all trying to do better, right? So a non-profit, for example, a church, is trying to make society better in some way, right? Or Red Cross, or some universities are also nonprofits, right? So what you're trying to do is you're going to improve society in some way that you find meaningful or important, okay? And how do you do that? Well, you maybe provide some services, maybe some goods. It depends on the kind of entity you are. But the essential aspect is that you're going to get some fundraising in there. So you're trying to ask people for resources so that you can actually achieve your task, okay? And you're not trying to make money. So there is no profit as a goal in the case of a nonprofit, and this has implications for tax purposes. So if you're a non-for-profit and you file with the Internal Revenue Service, one of the things you will have to not do is pay taxes, which is kind of nice, I guess, right? And now, when it comes down to both businesses, traditional businesses and non-for-profit businesses, there is a whole host of stakeholders at hand. Stakeholders is any person or entity that is related in some way to the activity of the firm or nonprofit, okay? So you're going to have things like management, right? Workers that work at the firm or the nonprofit. You also have consumers that also have a relationship with the firm in some way, okay? And maybe society at large, right? Also, if you're a traditional firm, and owners of the firm will be stakeholders, right? So when you're talking about stakeholders, you're talking about everybody that relates in some way to the activity of the firm. Okay. Now, within this firm, whether it's profit or non-profit, at the end of the day, you know, there are some differences, but they are small, because in both cases, you're trying to maximize how much service you can provide for society, or how much profit you can actually make. There is going to be 3 core activities that you need to be well aware of, okay? Because these are going to encompass almost everything that happens within the business, if not everything. Depends on how you define them. We have management, we're going to have marketing, which is where I come from, as you know, and we're going to have finance. Now, when I say management, I'm talking about management widely defined, right? It's how do you actually plan, organize, and control all the functions within the organization. So this is a broad definition of management. And that includes things like operations. We'll talk about that in chapter 8. Operations is essentially creating those products or services, right? We are also including here things like human resources. So it's a broad perspective of management. It's essentially trying to make sure that you're doing as well as you can with the resources that you have. So you're planning, you're organizing, and you're controlling the operations to make sure that you're successful at creating those profits, okay? And we're going to have another whole set of activities happening, which are going to be undertaken by the marketing folks. And marketing, for the most part, is anything that relates to the customer. We're talking about stakeholders before. Customer is going to be one of the focal stakeholders for any firm or nonprofit, because ultimately they are not going to want to engage with you in any exchange of value unless you really understand them. And marketing's job is going to be to understand your customers and then also making sure that we are communicating with those customers appropriately. We'll talk about all the aspects of marketing, chapters 11 and 12, maybe 13. At this point, 13 is not on the schedule, but if you're doing a lot of online stuff, you might want to consult the material that it's on 13. Okay. And finally, we have finance. Now, finance, it's essentially all the activities that revolve around obtaining resources and capital so that you can actually do the other activities of the firm. So for the firm to exist, you're going to need resources. And oftentimes those resources take the form of capital. Capital meaning money, whether it's a loan or it's cash or anything that will enable you to run the firm, right? So because of this, finance is going to play a primordial role. Let's look at this graphically, right? So here you have a graphic representation of how we are depicting the firm, right? So we have this outer circle here, the bigger one, right? That it's going to capture these three core activities that I was talking about, right? So you have management over here, okay? You have marketing over here, and we have finance. Now notice that these are the stakeholders here in the middle. You have your owners of the firm, and these are related to finance because oftentimes the owners put forward some of the capital, often not always, put forward some of the capital needed to start the firm. Sometimes they also found the firm themselves, right? We also have here employees of the firm. And of course, management is going to be related to employees because they are going to be one of the key resources that are going to make the firm successful. And here we have customers, right? The other key stakeholder of the firm. And like I said before, marketing worries mostly about customers, also about competition, but we'll talk about that later on, right? We have other stakeholders over here and other forces of the marketplace. We have other firms that are competing with us. We have the economy at large, right? We're going to talk today mostly about this aspect, the economy, right here. And we have technology in general. It doesn't have to be digital, right? Technology is a force that changes the landscape, right? And we have ethics, right? We're going to talk about ethics. I think it's chapter 3, right? How are we going to make decisions in a way that is sustainable in the long term, right? So that we don't end up in jail and we actually create more value for society at large, right? Do the right thing, essentially. We'll talk about that. And then we have other forces in the marketplace, like, for example, legal, political. We also have Mother Nature in here. You can ask COVID. It's missing in the diagram, but it's also here. And all this is going to affect your business, right? So this is a good depiction of the entire system of the business. So today we're going to talk a little bit about how the economy plays in here. So let's start with the economy. First is, what is economics? Economics, it's the science that deals with the production, distribution, and consumptions of goods and services. So because of this, it's going to be, of course, central to business, right? Because if you remember, a business is an entity that creates either products or services and sells it to customers. So economics is kind of like, if you want to think about it, as the mother discipline of business, right? Economics looks at the whole system instead of just one of the entities that will be a firm, right? Now, if you are mathematically inclined like I am, and a lot of economists are, I guess I'm a recovering ex-economist, right? So you can think of a country like the United States as a system that is trying to create as much wealth as possible, okay? And if that's the case, that wealth that you have created is going to be a function of the inputs that you actually have in the system. And what are the inputs? Well, we're going to talk about the resources that an economy has at its disposal, right? You're going to have natural resources, right? So for example, the United States is rich in many natural resources, right? If you go to the Midwest driving, you will see these huge fields of corn, right? So land itself, it's usually used to refer to these natural resources, right? By the way, in these mathematical models that you might see in economics, they use T for land because the word for land in Latin is terram, right? In Spanish, it's tierra, it comes from the same word. So it uses T. By the way, the reason why we use Latin is because we like to use the L of land for labor. You'll see that in a minute. Okay. So natural resources is all the things that come essentially from the ground. If you have a mine, that is considered land, right? If you have any natural resource, wind, if you have water, those are natural resources. Okay. Then we have human resources, right? And this is represented with an L in all these math models, and we call that labor. Okay, that's you and me working, like me right now, and hopefully you soon once that you finish your program, right? And then you have financial resources. It's essentially money, right? And the word we use for this is usually capital. For some reason, capital in these models is depicted with a K. Okay, and so if you see a K in any of the models, they are talking about capital. And then there are other intangible resources. This is the secret sauce. And I will argue this is one of the most important things. Sorry about that. I'm having trouble with my pen. It's entrepreneurship. You know, the secret sauce of making all these things work together is somebody that takes the risk of basically maybe losing all their money, time, and even their reputation by starting a business, right? By doing something crazy like, I don't know, start a restaurant, or start putting together computers in your dad's basement, or I don't know, any other endeavor that you think people are going to be interested in and maybe willing to give you some money for some of the stuff that you're going to make or create, right? So you can think of as an economy producing a certain GDP. We'll talk about GDP in a moment, gross domestic product. That's all the goods and services produced by an economy. Why? So this is your output. This is what you've done, what you've created, let's say in a year of hard work, all 350 million people that live in this great country, right? And that will be a function, if I can draw with this pen, sorry about my handwriting, it's pretty poor. It's going to be a function of what? It's going to be a function of your resources, right? It's going to be a function of the amount of natural resources you have. We're going to call that T. It's going to be also a function of the labor that you have. So that's going to be dependent on, for example, the amount of people that are available to work, but also on how productive those people are, right? So education hopefully plays a role into how productive labor actually is. At least that's the theory. It's also going to be a function of how much capital is available in the system. You know, how easy is it to borrow money, for example? We'll talk about interest rates, I think in chapter 15, when we talk about some of the financial system and implications. And it's also going to depend on the amount of secret sauce in the marketplace. That's the amount of people that are willing to leave their jobs, maybe secure jobs, or their parents' basement, maybe, I don't know. And they just take a risk and start a new firm or make a new thing, right? This is what I will argue by, you know, I've been in other countries too, other than Spain and the US. And this is what makes the US a phenomenal economy, among other things. But the fact that there are so many people willing to jump, you know, in the abyss and take the risk of launching a new firm. And yeah. So anyway, the idea here is your output as an economy, the whole system, is going to be a function of the resources that you have. So if you have more land, you're going to do better. If you have more labor, whether it is more qualified labor or more number of people that can actually work, you're going to do better. Same thing with capital, and same thing with amount of people that are willing to take a risk in the economy. So this is looking at the economy as though it were a production function. Now, what kind of economic systems are there? Are they all the same? The answer is no, they are not all the same, right? They're all different, but some are more different than others. If you don't get what that quote comes from, maybe we should talk about books that you should read. It's a bad joke, like they always are. So we're going to talk about typically three, although I will argue there are two purely distinctive economic systems. These two right here. You have communism and you have capitalism. I will argue socialism is very close to communism. It's kind of like a non-committal communist. Some people will get upset about this, but just if you read history, you'll see I'm right. It's important to read history so we don't repeat the same mistakes we made in the past. Communism, it's a system, it's an economic system and a philosophy that thinks that all resources that I've discussed before, land, labor, and capital, and also entrepreneurship. Entrepreneurship, at the end of the day, is labor. It's just a special type of labor. It's so unique that I separate it out. It's not just me. Every economist agrees that's an important secret sauce, like I said. Communism thinks that the government is the source of ownership for all these resources, okay? So as an individual, you and me need to ask permission for the government to do anything related to owning a firm. In fact, in a communist country, unless you are part of the government, you are not allowed to own any capital, right? Own any capital. You cannot own a firm. Only the government can. You cannot decide on your career either. Labor is told by the government what it is that they need to do. So you'll be told whether you need to be an engineer or something else. And the same thing, land is only owned by the government, right? You are not allowed to own your own land. You'll be given a place where you can live, but that can be taken away from you at any time because it's not yours. It's just for the good of the government and for the good of the system at large. That's a communist economy where every resource is owned and managed by the government. A capitalist society, at least in a pure form, is one where individuals own all resources. You and me have the right to own land, remember that was the T, to own capital, and to do whatever we want with the time that we've been given on this earth, right? That will be labor, right? So we can decide whether we want to study to maybe better our productivity, that theory goes, or maybe we want to start working right off of high school, or just, you know, in the US at least, I think you need to go to high school, right, by law. So the idea here is individuals are free to own these resources, and because of that, you can be an entrepreneur. You can start your own firm because you can own capital, you can own land, and you own your own time, right? So you can do this. Okay. And then what you're going to do with those is, if you do a good job, you're going to make money. And it's not easy to do a good job, by the way. Okay. Socialism is kind of in between. And socialism is saying, look, we should let society manage this system. Some of these resources can be owned by the public, but if it's in the good of society, we will just take those resources from individuals and manage them differently. So you can appropriate whole industries. This has been done in multiple countries. Look at what has happened in Venezuela, for example, where companies like BP, British Petroleum, were stripped of all their capital and land, etc., that they actually own or were given or paid for in the past, because the government decided that now they were of national importance, and because of that they were going to take off everything for themselves, and they were going to kick BP out, right? So that would be pure capitalism. Modified capitalism is where the government does play a role, but it's a minor role within the economy to try to make sure that things don't get out of hand. As you can imagine, by the way, both of these systems have positives and negatives. I'm going to talk a little bit about some of those in the later slides. But in reality, every economy in the world is a mixed economy. What do I mean by that? It's going to be a mixture between principles from communism, maybe socialism, if this word bothers you at least as much as it bothers me, and capitalism, right? Which, by the way, bothers other people a lot. Even though empirical evidence will tell you that this works and this doesn't, but I digress, right? And mixed economies are economies that are, to some degree, they let the market forces dictate what's going to happen. That's what a capitalist economy does. But to some degree, they impose laws and regulations that limit the amount of things that these individuals can do with their resources, right? We're going to talk about examples like that in the US and other countries. So let's compare those a little bit. And I'll focus mostly on communism and capitalism because, like I said, socialism is kind of like a decaf version of communism. Okay? And now, if you've ever seen what goes on in a communist country, and by the way, the cool thing nowadays with social media is you have access to this. So go to YouTube and find a documentary that narrates what's going on right now in communist countries like Cuba, right? Where some people have gone in and recorded how bad things really are, right? So that you can see that it's not me telling your story or the book telling your story. These things don't work, right? And we have the data to prove it. And we have over 100 years of this, right? And many countries and many millions of people dead because of it. So in a communist country, essentially what you're going to have is business ownership. It's totally owned by the government. The government dictates everything. They dictate what products are going to be made, by whom, right, and in what firm. And they dictate the prices of those products. There is no competition, okay? So the government dictates whether anybody has a chance of producing or not, and in traditional communist economies, only the government itself will operate. So if you go to old days Russia, I have a good friend who spent quite a bit of time in Russia when the Iron Curtain was still up. There are no brands, and the only brands that you can get in communist countries are contraband that has actually slipped through. All products are not branded. All prices are set by the government, and quite frankly, there is no variety. Okay, every car is exactly the same. There are one or two models, and everything is painted in the same color. Okay, and profits, there are no profits. Why? Because the only entity that can own capital is the government. So if there is any excess income, it goes to the government. Okay. Now, how does that compare to capitalist society? Well, in a capitalist society, an individual basically owns the land and the capital, etc. Okay, so they get to own businesses if they want. Maybe you cannot own your own business if you're like me, who are not maybe inclined to start your own business, right? But you can still buy stocks in a company and that way own at least a little piece of a business. Most people, I shouldn't say, a large portion of the population in developed countries own stock or mutual funds, which is essentially a financial asset that enables you to own stock in a small way. Okay. Competition. The idea of capitalism is to encourage competition. Competition is seen under capitalism as a force that enables the economy to get better. The bad firms die and the good firms move forward because they are doing a better job, hence making more profit, hence making things better for consumers. Okay. And profits, individuals get to enjoy those profits because they are willing to take a risk, right? So the reason why an entrepreneur makes more money is because they are risking all their maybe capital, reputation, and time, right? And you might have to pay your taxes, which will be the part the government will keep of those profits, but at least you are left with a large enough incentive for you to take that risk. What about product availability? I think I already touched on some of this. In a communist economy, there is very limited choices. Usually, if you have bread, there is one type of bread, right? You can go to Cuba and see how things are. Right? Whereas in the US, it's the opposite. Go into any supermarket and count the number of salad dressings, right? You will get bored after you get to 80 or 90, right? That's just salad dressing, right? So you have a wide array of choices. And by the way, some people will argue choice is not a good thing, and I understand those limitations, but there is a marked difference. Okay. And then even maybe more importantly, given that we're talking about education, employment options. In a communist country, you are told what you're going to do and you work for the government. Okay. Whereas in a capitalist society, it's up to you. Now, this has a risk, right? Nobody's going to tell you what to do, so you could do nothing. And that's not a good thing, right? But on the other hand, it opens the world for you. You can decide what you want to be, and now it's the time for you to think about these things, right? By the way, most of Europe, I would argue, falls somewhere around here, if not every country in Europe. And there is a little bit of less that I've said on the right side. Also, like I said before, all countries are mixed economies in some way, so this is a little bit of the extremes. There's just mostly gray areas everywhere. So what kind of economies can we consider capitalist economies or free enterprise system economies? Well, countries like the US, Canada, and South Korea, not North Korea for obvious reasons, and Japan, although there's a lot of regulation in Japan, but maybe less in some of these countries. Okay, so the role of government in Japan, for example, is more prevalent than it is in the US. Okay, and also more in most European countries. Okay, but they mostly function as a free economy in the sense that you can own firms, you can start firms, you can own capital. There are some socialist countries that in the last 20 years have changed their systems to enable a lot of the competition to, and not a lot, some of the competition to take place. Best example of this, I would say, is China. Okay. China is a country where the government still exerts immense control, both inside and outside of the borders, right? In fact, until only a few years ago, you couldn't start a business unless there was a local business that was actually mediating all your business affairs. Now you can do it, but the government is still heavily involved in what you do and you don't do. Okay, and this has enabled China to grow rapidly. The fact that they are operating in some degree like a free market because it gives incentives to people to do stuff works. It will make your economy grow. Okay, and the idea here is, like I said, it's a meritocracy. You fail or succeed depending on what you do. And this is something that it's scary, but it works really well. If you get people incentive to do stuff, they will do it. If they're gonna make the same amount of money regardless of what they do, guess what? They'll go to the beach. I will go to the beach if I could, right? So, yeah, based on merit. What else? I've already mentioned, but let me reiterate again. Free enterprise is based on some rights that are not observed in communist countries. Okay, first is the right to own property. Okay, so the government cannot come whenever they want and take it from you. Okay, there are cases like eminent domain where the government in front of a judge needs to make a case that it will be for the better of society to that property to be sold to them, not just taking it from you. So they'll have to at least giving you just payment, whatever that means. By the way, I'm not a judge, I don't know anything about that, but you know, there are very small occasions where this can be forfeit. This is an essential right in countries like the US. Okay, you also have the rights for income, okay, and do whatever you want with your money. This is essential, okay, so that you can basically decide to invest it into a firm or start your own firm with it. Okay, you also need to be free to determine your operations, right? And of course there are some boundaries, right? For example, let me give you an example. In this country, it is illegal to sell something at a price that is lower than its cost. So if the variable cost, which we'll talk about later on, it's, let's say, $10, you cannot sell that, let's say, t-shirt for less than $10. Okay, this is small restriction on what you can do. Other than that, your operations are free, you know, to be decided by you. So what it is that you're going to make in your factory, you decide. Okay, there are some conditions though, obviously. You cannot put poison in your Pop-Tarts and try to sell them, right? So there are some conditions. But say from that, you can decide whether the Pop-Tarts are going to be strawberry or raspberry. It's your choice. Nobody's going to tell you. The government is not going to tell you what you need to make, how much you need to price it, etc., etc. Okay. And most importantly, you get to choose what to do with your time. These things are not true in communist countries. I know for us, because we've had this for most, if not all of our lives, it sounds crazy, but that's the way it is. Now, how does and why does the free enterprise work so well? The answer is because it lets the market decide how to assign these limited resources that we have. How does this work? Well, let's talk about the most powerful principle in economics, and that's the supply and demand principle. Okay, so let's pick something that I like, for example, chocolate, right? And let's say that this is the number of chocolate bars, right? We're going to call Q for quantity. The number of chocolate bars that are going to be exchanged in the marketplace. And this is the price that we're going to pay per chocolate bar. Let's assume all chocolate bars are the same size, flavor, and everything. Just to keep it simple, you can have multiple sizes and it doesn't change anything. Okay? Now, this that I'm drawing right here, we're going to call the demand curve. Now, let me show you why this is the demand curve and not the supply curve. That's a D. It doesn't look like it, but that's me. Okay. The demand curve, it's downward sloping on price. What does that mean? If I'm a factory or I'm an entrepreneur that has decided to make chocolate bars, right? What I will do is I will offer more chocolate bars at a higher price, right? So if I'm the company and I'm the one supplying the product, this is not gonna demonstrate anything, right? Because what happens here, as you can see, is for this price, the quantity provided in the marketplace, which I'm gonna call Q1 because I'm boring, right? So for this price, P1, right? How much quantity I'm gonna have in the marketplace is that at this lower price, guess what happens? The quantity that I'm going to observe in the marketplace is larger. Okay, so P2. So what this means is this is how much consumers are interested in buying in the marketplace. Why? Because guess what? If you charge me a high price, I'm only going to buy this many bars. But if you charge me a lower price, guess what? Now suddenly I want more bars. Notice that this number is larger than this. Here is the 0. And these are numbers that are larger. So if this is 5, for example, this will be 10 cereal bars. Sorry, cereal, no. Who wants cereal bars? Chocolate bars, right? So this is the demand curve. This is what people want at different prices, right? So if you charge a really high price, look, if you charge a price higher than this one right here, the demand you will have is 0. And that means that nobody will buy your cereal bars. Okay. So you can charge whatever you want. This curve dictates how much you can actually charge in the marketplace. And then you have the supply curve. Let's make it a different color because it's a different thing. Here you have supply curve, right? And why is this supply? Because the opposite happens, right? If you extend those prices and you see those quantities, here you have a quantity, right? This is going to be Q3 because it's different. And this quantity right here, it's going to be Q4. Now notice what happens, right? At a higher price, P1 is larger than P2. I'm assuming everybody agrees with this. If this is hard for you to see, assume this is 7 and this is 9, for example. Right? Because 9 is larger than 7, 9 is larger than 7. And let's say that this is 12 and this is 8. What you can see is at a higher price, I'm willing to offer as a company more chocolate bars. How many? 12. This is how many I'm willing to make. And at a lower price, guess what? You know, because I'm not making so much money, I'm only going to make 8 chocolate bars. And the beauty of supply and demand is that if left to their own devices, what you will observe in the marketplace is an equilibrium price where supply and demand meet. Let's say that this is 8. At a price of 8, demand and supply are going to be the same. You can see that in the diagram because they intersect. And that means that there is agreement between prices and quantities between the company and the consumer. Okay, and by the way, the quantity will be, I don't know how much it is, it's just exactly right here. okay? And this we call the equilibrium price and equilibrium quantity. This is where the number of, in this case, chocolate bars that the company is willing to make at the different prices that consumers are interested in paying is the same. So at this point, everybody's happy. At least happy in the sense that they are in agreement as to how much they should produce and how much they should charge for those bars and how much they will buy, how many bars they will buy from them. Okay. This allocation of scarce resources is the reason why free enterprise works so well, because you leave it up to the market to decide how many chocolate bars to make, how many cereal bars to make if you also want to eat something maybe a little bit healthier. I'm not sure cereal bars are healthier than chocolate bars, but that's a story for another day. Right? Good. Now, to add to this story and to make this story complete, you need to encounter competition, right? What happens when there is more than one firm? The answer is they will compete. They will compete. How will they compete? They will compete in many things in reality, but if you don't let them compete in anything except price, you will have what is known as pure competition. Okay? That's when firms make essentially something that is the same. That happens, for example, with oil. Okay? Oil, it's essentially the same within certain type of characteristics like sulfur content, which we're not going to talk in class because this is not about oil, right? But within certain standards that all firms meet, the price of oil only depends on the price in the marketplace, okay? There is nobody branding their petroleum oil as being superior to others. I know at the gas station level they do that, but if you're buying it by the tanker, oil is just oil, okay? So there is pure competition in this case. And when this happens, you can prove it, and I will not do it in class to not confuse anybody, but if you don't buy this or you want me to explain it to you, I'll be happy to spend 30 minutes with you in office hours. But what this will mean if there is pure competition, because new firms will enter unless you charge a low price, it will mean that the price that you will see in the marketplace will be equal to essentially your variable cost. Okay? So you will be making essentially minimal profits. Okay? So you will have a pretty low price, and because consumers like low prices and they can buy more things because of it, consumers, at least to some degree, will be happy. Okay. The opposite to pure competition is a monopoly. Okay. By the way, in real life, monopolies only happen when the government is just in charge. So it's when the government doesn't let other firms enter. Otherwise, firms, when they see somebody making profit, they will jump in the marketplace because it's attractive. There is money to be made. Right? So in a monopoly scenario, your price will be different from your variable cost. And in fact, your price will be higher than your variable cost, and you will have large profits. In fact, you can prove mathematically profits by, this is profit, how much money you make. Okay. You can prove that under a monopolistic scenario, your profits are maximal. Okay, meaning that in a traditional optimization sense, you will charge a price that will yield the maximum profits that you can extract from the demand equation. Okay, so prices in a monopoly will be a lot higher. And the reason why they are a lot higher is because nobody else can come in and force you to charge a lower price. Because if somebody could come in, they will price it lower than you and take most of the demand from you. And then you'll be forced to lower your price again, and everybody will lower their price until they get here. Okay. Couple other special cases of this. An oligopoly is when there is a few firms. Oligos means the few or the chosen ones in Greek. So this is when there are 2 or 3 firms. Where can you see that? For example, cell phone carriers in the US. And this is, by the way, only occurring because the government limits the number of licenses that you can have. If the government wouldn't intervene, there will be more firms in that space, and it will probably not be an oligopoly. So these 2, I will argue, are mostly a function of the government regulation. And then you have monopolistic competition, which is when you compete in something other than price. But it's in the traditional economic literature, this is something that is not that important. Like, for example, the color of the computer. right? So it's not like the performance is better. It's just that, maybe you have different interests. So maybe I like it blue and you like it purple. You like whatever you like, right? Anyway. So the more competition you have, the lower the prices and the lower the profits. That's the essence of it. Okay, other things that you need to know a little bit about inflation. Inflation is a generalized increase in prices. Okay, so what you buy as a basket of goods today is probably cheaper than if you buy the same thing a year from now, okay, or the same collection of goods and services. Okay, and we call that inflation. Inflation is pretty low in countries like the US. 2-3% a year. In other countries, it goes rampant. You can see in some South American countries where inflation is so high that people don't even use their currency because it's worth nothing from one day to the next. That's when prices today are twice as much as the ones yesterday. That's craziness, but it happens. Okay. Recession. This happens because the economy overall goes in cycles. We don't know why. We have some theories, and some people argue one way or the other. But the economy, if you look at the output of an economy like the US or any other economy over time, this is time, and this is the output, which could be, for example, GDP. We'll talk about it in a minute. Okay, you will observe the cycles. And when the economy is on the up and up, we talk about an expansion of the economy. When it's starting to go down, we talk about a recession. And if it stays going down for a long time, we talk about depression. Okay. Now, whenever you see a recession and depression, what will happen is some of the markers of a healthy economy will go away. So you'll see things like unemployment. Okay, and let's talk about that right now. Right? So here you have unemployment in the US. This is time series that covers some years. By the way, the scale is off. So over here, these are tenths. So this scale is in 1 units, and this scale from here on is different units. These are just years. Okay, so the fact that this diagram looks a little bit different between one side and the other is just also a function of the scale. So you should look at this side and then this one. They're a little bit different. Okay? But that aside, and it's not important, you have to see here there is different levels of employment depending on the time. Most economists will agree that unemployment under 4 or 5%, anything under here, is called full employment. That's because people are switching jobs, and because of that, there is a little bit of residual unemployment. But anything higher than this, it means that people want to work and they cannot. They can't find a job. Okay, you can see what happened in 2008 with the recession. There's a bunch of unemployment here. Right now, this came down to a low of 3.3. That was at the beginning of 2020. That's historically low. Right? One of the lowest unemployments in the history of this country, and any country for that matter. And then because of COVID, it went up to, I don't know, what was it, 13%? Okay, and now it has started to come down. I think now we are around 10% unemployment. That's the latest figures. Okay, so hopefully we can make this thing come down quickly. I don't know, we'll see. It's gonna be hard. When people are unemployed, it's a big challenge, right? Because they can't pay the bills. Okay. It makes things hard for everybody. What else? To measure the size and growth of an economy, we use the gross domestic product. That's the total output of a country as an economy or as a system. Okay, so this is the addition of all the products and services produced in a country. Of course, multiplied by their prices so that you can add everything in dollars, right? Or whatever country currency you have. Budget deficit is the difference between how much the government makes in taxes. Of course, the government doesn't make anything, and how much they spend, right? So there is a deficit when the government spends more than they actually receive. Notice that the government is probably the only entity in reality that can sustain a deficit in the long term. We've been doing this for years, right? If you as an individual try to do that, meaning spend more than you actually receive in the long term, you'll go bankrupt. You cannot do it. But the government, anyway, can. This is the gross domestic product. I want you to notice again, the scale changes here. So the fact that the slope is different over here means absolutely nothing. I don't know why the book does this. It confuses things. These are tens of years. These are years. Because of this, you cannot compare the slide. What I want you to see is I want you to see that it's been growing at least for the last 60 years. Okay. There have been some hiccups like here. Okay. but for the most part, we've been growing. As an economy, we've done very well. Okay, what else do you need to know? Trade-off balance, what is this? This is the difference between the exports and your imports. So if you export more than you import, you have a trade surplus. If you import more than you export, you have a trade deficit. That's what we have with China, a trade deficit. With other countries, we have a surplus. Okay. Consumer price index, this is a measure of inflation. I'm not going to get into how to compute it. If you're interested, you let me know. I will be happy to show you. Okay. What is per capita income? Is income divided by the number of people, right? So you can take the total GDP and divide by the number of people that live in the US. This is an indication of how well each individual is doing on average. Problem with averages is that, they may or may not be representative. Unemployment rate is the percentage of people that cannot find a job right now. Like I told you, today is around 10%. Perspective, in Spain is over 20%. So yeah, 10% is bad, no question. I told you anything above 5 is bad. 20 is a lot worse though. And inflation, it's a generalized increase in prices. This is a measure that we use to measure this. This is a concept, this is a metric to measure that. Okay. And worker productivity is how much output a worker produces. And you can, of course, standardize this by making it in dollars. Technology and education is what increases worker productivity. The fact that you have iPhones and computers make you a lot more productive, I hope. Okay. So what is the US? Like I said, it's a mixed economy. It's mostly funded or standing on capitalism. And if anybody tells you different, please have them read history and see what happens when you remove that from the equation. Standard of living is extremely high. Every poor person in the United States is in the top 5% worldwide. You need to understand that. If you compare to other countries, everybody in the US is doing well, no matter how badly they are doing compared to some people in the US. Okay. It's an open economy for the most part. I've already told you the metrics that we use to assess this. Let's talk a little bit about taxes. A lot of people like to talk about that and justify why communism is a good idea through inequality. Let me show you, this is data, this is not opinions. By the way, I try to refrain as much as possible from giving opinions in class. Opinions are like noses, everybody has one. Just because you have an opinion doesn't mean anything. Same thing with me, I'll try to keep mine as much as I can away. You are an adult. Look at the data and make up your own opinion. This is real data from the IRS. This is not from my buddies. This is just from Uncle Sam, right? Internal Revenue Service. These bars that you have here in this histogram is the number of returns filed. So this is, people filing their taxes. So you can see that, most people that file their taxes, right, have an income that is less than 15,000. That's about 20% of the population. Between 15,000 and 30,000, that's another 20% of the population. You have about 18% that are filing here, etc., etc. I think you get the point, right? Those are the blue bars. What are the red bars? That's the amount of income tax that they pay. Okay, that's how much you pay to Uncle Sam. That's not how much you get back or anything. Pay total. Okay, you can see if you make less than 15,000, you pay nothing, as in zero. If you make between 15 and 30,000, you pay a teeny bit. This is percentage of the total money that Uncle Sam gets. Okay, this is almost nothing. Okay, notice, by the way, this is 40% of the population paying almost nothing. Okay. If you make less than $50,000, the total sum between these two little bars is the total that this 60+% of the population pay. Okay? Here, the evil rich that make more than $250,000. By the way, most of these people are business owners. They create jobs for other people to work. Okay? This small percentage, I don't know how much this is like 3% or so, pay 48% of all the tax load in this country. By the way, this is not my opinion, this is the fact. Okay, so when people tell you that the rich don't pay enough, ask them how much they should be paying, because they're already paying half of all the taxes. This is income tax, by the way. Sales tax is different. I know, I understand. What else? We're gonna wrap up. right? I'm going to leave this history thing. You can read it yourself. We're in one of the greatest countries in the world, if not the greatest. If you ask me, the greatest, but what do I know, right? I've only known a few others. I haven't been in every country, so I can't say the greatest, but it looks like it to me. This kind of walks you through the book, how it started, with hunter-gatherer economy when you have the Native Americans, all the way to right now where we are all shopping in Amazon because thanks to COVID, nothing else is available, right? So you can walk through that. COVID is not in the book, of course, but you get the point. Now let me talk about this quickly and then we're done. What is the role of the entrepreneur? The role of the entrepreneur is massive. They are the force that starts the company. And it takes a lot of risk to do this, especially in some countries. In Spain, if you fail, people will point at you in the street. You are like the guy that failed, right? That's very, very toxic. It really dampers the economy a lot. Here in this country, it's not like that. And that makes, among many things, this country great. So being an entrepreneur in this country is actually admired. Okay, look at company entrepreneurs, serial entrepreneurs like Elon Musk, right? Look at his portfolio of companies that has either managed or started, like PayPal, right? SolarCity. Anyway, the list goes on, right? So he's an entrepreneur, right? And he's handsomely rewarded for it. He's the fourth richest man or woman in the planet, right? So this system, economic system, rewarding risk is the reason why we have this amazing technology at our fingertips. If you've ever ridden in a Tesla, you know exactly what it is that I'm talking about. And if you haven't, you're in for a treat when you do, because it's like a roller coaster ride. But I digress. And so the entrepreneur plays an absolutely essential role. If you don't have entrepreneurs, the economy dies. And they create a huge percentage of the wealth and the growth in the economy. So if you dampen entrepreneurship, you do so at your own risk. And now about the role of government, there is different opinions about what will be best, but I can tell you that as it stands right now, to some degree, it's basically modified capitalism. So the government is only going to interfere and create some boundary conditions, but not own capital and own firms. Although that's not 100% true. You have, for example, government-owned companies like the Postal Service, right? But some will argue that's absolutely necessary. Or other people will say FedEx can handle it. And there are two opinions. And you see this in every election, the left and the right at it, about how the government should actually act. And you should hold your own opinion. Read enough and just make up your own mind, right?